Welcome to the Virtual CPA Success Show, where we're 100% focused on helping service-based businesses achieve success. Are you a business owner interested in learning how to scale your business? Has your business reached over $1 million in annual revenue? Then this podcast is for you.
Welcome to episode 8. Today, we have a very important topic that I'm not sure everybody out there is doing right now. Today, we are going to talk about forecasting. So first off, we're going to talk about some terminology. We know a lot of companies out there do budgeting, but not all companies do forecasting. So I'm going to start off with you, Jody. If you want to talk a little bit about kind of what the terminology we're going to use and what we're going to talk about throughout this podcast. And just as real introduction here, I do have Jody Grunden and Adam with me again today. So that's the people talking to us about this topic, and they'll really give us some good info. So Jody, start off by talking about kind of the terms we're going to use throughout this podcast.
Yeah, sounds good. So the first term is budgeting. And budgeting is probably what everybody here is familiar with, where you start out, or we call it the plan. Once you start out at the beginning of the year and you try to figure out, hey, here's what we're going to have in revenue, here's what we're going to have expenses. It could be broken out by month. It may not be, depending upon the company. And then the very bottom line is, here's what we're going to have in cash. And so typically a budget's going to be revolving around a profit and loss statement, your typical income statement. With forecasting, it's one step further. So we're taking that budget or plan and we're making it dynamic. So the forecast is typically starts with the revenue side, where it's adjusted every month based on what actually does happen, throughout that year. So, like for instance, at the beginning of the year, you may not have saw that we were going to actually hire 2 new people in February. We're doing that, and so that number will obviously change what was in our forecast if we didn't have it in the original budget. And so that's more of a dynamic thing. It's going to change on a monthly basis, and it could be drastically different. More than likely, it's going to be drastically different at the end of the year. Resourcing, Adam, you want to go ahead and shoot at resourcing?
Yeah. Before we jump into resourcing, the analogy that I always like to use with the team and with my clients and everything, as it relates to forecasting versus budget, because those a lot of times are used interchangeably. But the way I kind of think about it, I personally like to go on vacations. And so, like anybody else, whenever you need to go somewhere that you've never been before, you kind of have to map out what's the best way to get there. If you were going to hop in the car and take the family to a trip, sure, you can just keep driving south until you hit the ocean. Hopefully you'll get there. But you really need to have, you plot in the coordinates, where you want to go. That's your goal. And you put that in, and that puts out the plan or the budget. That's the static piece. But unless that just goes perfect, which it usually doesn't, at least whenever I go on vacation and get in the car, what ends up happening is you get stuck in traffic. People have to pull over. Just life happens once you get in the car. That's what the forecast is for us. So the forecast gives us the ability to reroute, still get us to the goal, and kind of estimate, what does that mean? Does that mean it's going to take us longer to get there? Are we going to be able to find a shortcut to get back on our timing? And then we use tools like KPIs and metrics they're kind of like the road signs. They're the ones that either tell us where we're at right now or what we need to do in order to get the rest of the way. So that's kind of the analogy that I like to think about whenever I'm kind of comparing the difference between like a forecast and a static budget. I just kind of taking it back there.
That's a great analogy. So would you say, getting back to resourcing, would resourcing being, at least for my family, how are we going to make it to the next gas station? Is that kind of the resourcing part of it?
Absolutely. That's perfect. That leads in great. Because resourcing is really just, that's what most people do, either in an Excel spreadsheet, or they'll use something like Harvest Forecast or something else where you're planning out your people. So you're doing your peopling to figure out who's working on what projects by discipline or whatever. And sometimes people have a longer, they'll work with bigger projects and they can plan that out for 3 or 4 months. And a lot of times it's more of like a week to week kind of a change. But they really do fit hand in hand, because once you have the plan and you're happy with getting to where we all have a mutual understanding of how we're going to get to this goal and what we need to do to accomplish it. And then, of course, when life happens and people change jobs, customers come and go, that kind of a thing, and we reroute, then we can kind of use that resourcing to understand, how we're going to get to that next milestone. And so totally different concepts, all equally important, but they serve just different, they have a different purpose along that same path.
Yes, I think what we find is a lot of people do budgeting. A lot of people go into the year, and if I was to ask the majority of the companies that we work with before we even start working with them, what is your plan for 2020? They can at least give me a revenue number, maybe a net income number, and maybe cash goals. So that would be the budget. And then a lot of companies do the resourcing. They know what the next 3 months looks like. They know what jobs they have signed. They know who's working on those jobs. And so they kind of do those two parts of it. So the part that we usually come in and fill in is the forecasting. And that's the part that Adam talked about. So, Jody, you want to talk about why we do that second part, why we do the forecasting, why it's so important?
Yeah, for sure. And kind of even taking a step back, when we first started delivering virtual CFO services back in 2002, 2003, typically nobody really gave clients the ability to actually forecast. Clients didn't typically have that ability. The technology wasn't there. The advisory services weren't there. And so it was something fairly new. And so we started off giving it as more of a budgeting thing. Hey, just like Adam said originally, here's what we're thinking about doing, throughout the year. And then quickly, the clients pretty much smacked us right in the face and said, hey, we don't care about this. It doesn't do us any good to look at this number over and over again because it's not even real anymore. It's like, oh, great. We look back and see how great we did at predicting, and that was pretty much it. And they wanted something more and more that they could actually use as a tool to make those business decisions. And so that's when we decided, hey, let's see if we can flip it around and make it more dynamic and do the forecasting. And it wasn't probably until 2004, 2005, we started implementing forecasting in it. And that's when everybody's like, wow, this is exactly what we need. This is exactly what we want. And the funny thing is, all the big companies are giving it to their employees. That's how big companies did all the time, because they had an entire finance team and accounting team on staff that were delivering this type of service in-house. And these smaller businesses, the $2, $3, $4 million businesses, didn't have that type of expertise. And so once we started giving them that type of insight where they could actually start making decisions, that's when their businesses started really rocking and rolling, and our business did as well, because it was like, wow, this is something so great. We want you to share that with your buddy, across that you met at the last conference type of thing, or that you hang out with all the time. And so it was one of those things that really we helped our clients really get that insight. In the same respect, the clients really helped us actually grow as a company to be where we're at today. And so that's kind of our main thing is teaching a client how to look forward and help make those strategic decisions.
Yeah, and I think the important bridge there too, kind of bringing back into resourcing into it, is that a lot of times whenever people did go and try to be more dynamic, they were looking at what they have right in front of them. Accounting firms do this too. Like we'll meet with accounting firms and they don't even really have a dynamic forecast. They're just working with what they have right in front of them. But what they're forgetting about is that common goal that we set at the beginning. The forecast is what you should be doing. Not resourcing is what you're going to be doing or probably going to be doing. Obviously that can ebb and flow a little bit as well, but the forecast should really be, it's like gravity. It should be drawing you back into center so that you can get to that goal place. And so that's kind of the difference, because I think a lot of times exactly what Jody said, people abandon the budget. It's worthless. I don't have those same team members. I don't have those same customers. That's for nonprofits. True. But then if you just take resourcing, you might be driving to the worst place possible, and you might run out of gas halfway through because you're not paying attention and you're not thinking about where you should be based on the team size, because that's really, we build the forecast around what your current team is always, and that's how it stays dynamic. What should you be doing based on how much you charge your customers, how busy your people should be, based on your expectations of them. So I think that's an important distinction.
And I think the important thing here too is we talked a lot about people changes and stuff like that, but also sometimes goals change. And so I think that's the other important part of forecasting is you don't want to say, oh, we really want to purchase a new building, but we can't talk about it till budgeting season, so we have to wait till November and we're in March. We don't want to have those conversations. We want to have those conversations as soon as we're ready. And if we have an active forecast, it's really easy for us to plug something that in and say, okay, let's plug it in September and see what happens. What does it do to our cash? What does it do to our profits and all that stuff, depending on what the change is. And so I think that's the importance of forecasting. It gives you that real-time decision-making ability that you don't have if you're only relying on a budget.
For sure. And I would say forecasting, not just for the year, for the December 31 year, but you're always forecasting going forward. I mean, when we look at stuff, we're not looking, we do look at the December 31st, but that's more for tax purposes than really anything else. we're not obligated by financial covenants or anything like that, where that's a really important date for us. So really the only date December 31st is for the IRS. If you're in the States, really you want to continuously look over the next 12 months, over the next 2 years and 3 years and so forth. We're pretty corny. We've got our forecast built out to 10 years. And so we've got a pretty good insight on where we're going to be 10 years from now, making very conservative assumptions, along the way. And that's the key there, because you never want to just look too short-sighted, the next 3 months, 6 months and so forth. You have to look at that for short-term reasons, but long term, that's what you're in business for. So you need to really look and say, hey, where we're going to be, how's this decision really impacting, 2-3 years down the road? How's it impacting, 5 years? I'd say most people on this podcast couldn't tell you how it's impacting a year, and you really should be looking even beyond that and taking it, that even one step further. When are you going to retire? When are you going to sell the business? When are you going to do whatever? Well, that's all part of decision making today.
Yeah, now you're talking my language. I mean, that's exactly what I like to talk about with clients is like, hey, what's the end game look like here? Cool, you're having fun, everything's great. That's fantastic. But like, what are we building towards? And then the years you just break down into micro goals, how you're going to get there. If you want to be a $10 million agency and you're at 2 million, well, obviously that's not the plan for next year unless things just go crazy. Maybe that's a 3-year build or a 5-year build based on pace and, what you can scale at a 20% growth rate over the next 5 years, whatever that looks like. Forecasting gives you the ability to set that longer range plan with very bite-sized goals along the way and be able to see as they build. If you build it dynamic with metrics, it makes a lot of sense, and you can reason through how you're going to get to $10 million.
And there's a lot of power of having stuff written down on paper. I think that's one of the things I've noticed with forecasting with clients for the first time is that just coming up with a plan and a long-term goal of having something on paper just gives you the freedom to go out there and do it, right? Like, okay, we know we want to become a $10 million company. This is what we need to do. And these are the steps we need to take along the way. If you miss a step, okay, let's push it back a month or two. And then the goal is still there. It's just might be at a different time frame. And so I think there is a lot of power on having it on paper, not only the goals, but what you think those micro steps are. And it really gives you that freedom a little bit to run your business. So I think that's really important.
Yeah, for sure. And to add to that, when you look at your goals and everything, you're looking at a profit and loss typically. Your goals really are not really profit and loss. That's kind of like a phantom number out there. Your goals really are how much cash I want to have in the bank. Where do I want my liquidity to be? Do I want my debt paid off at a certain time? Those should be your goals. That's kind of what you're shooting for. Your profit and loss is how you get to those goals. And so it's important to understand where that's going to hit. So your forecast being dynamic really should have that on display as well. Are you going to hit your cash reserve goal by June of next year? Or is it going to be July of next year? You're going to have that line of credit paid off by the end of the year? Or is it going to be more towards January, February? When you're making those decisions, it's very important to know where your financial health is of your company at any particular time, because that's going to, or should, it doesn't always, but it should sway, how those decisions are made. Should I take a year-end distribution out in December, or should I wait until April, for tax time? If I take out in December, I might put myself in a cash crunch in January, February. You need to really know that information before you act upon it.
Yeah, I think the toughest part too, sometimes with forecasting is like, okay, so I can sit down and plan my goal and where I want to be and then, use my metrics and roadmap everything. But then how do you operationalize the forecast? To your point, Jamie, putting it on paper, you have a lot of smart people on your team that maybe control different parts of the business. Maybe it's just you and you're wearing a bunch of different hats, but being able to understand what that is and logic through how you're going to get there, meaning you understand your metrics, you understand your capabilities and how you're going to get there. You can then back into marketing plans and marketing strategies. You can put together profit share plans for the team. You can put together sales goals and commissions for, the biz dev area, those kind of things. Without the forecast, it's extremely difficult to operationalize getting somewhere because you just don't have it on paper where you can kind of show everybody the logic. Because as Jody said, we got a 10-year plan. They're very conservative goals. I'm a pretty conservative person whenever it comes to that. So what he did was he walked back the plan and he's like, look, this is how we're going to get there. Do you agree with these steps? Are these possible? I'm like, yeah, these sound doable. It's not pie on the sky stuff of, hey, we're going to get to $100 million, that kind of a thing. It's really tangible and something that you can look historically back to kind of prove your ability to forward look at those goals.
Yeah, great. Okay, so I'm listening to this podcast. We've convinced them. I'm ready to do a forecast. How do I start? Adam, if I'm starting a forecast tomorrow, where would I start, and how would I start on building that forecast?
Starts with your team's ability. I mean, we're working with obviously service-based businesses here. So we're leveraging not a machine, but we're leveraging people. So it comes down to their capacity. And so depending upon, your product and what you're selling, the actual capacity of the employee is going to be different. So I have some agencies that, especially if they're on the SEO or PPC side, where they're driving at like revenue goals rather than looking at average billable rates and things of that nature. So whether you're starting with how much an employee can do in order to get you to a certain spot, you can still walk backwards a little bit, look at how long, what's the utilization of that employee. So even whenever I have clients that don't even track their time, I still just walk into a feasibility study. So great, you have 15 people on your team, you had a $6 million sales goal. How are you going to get there? That means each employee has to do this. Well, how much do they work a week? What after PTO, all that kind of stuff, driving at that net utilization number. Then I'm like, great. That means that you on average charge about $700 an hour. Well, no, I don't charge $700 an hour. I'm lucky if, we make $150 an hour. Well, then your current team size isn't going to be able to get you to that goal. So what does that mean? Then you go back into the forecast and you scale it up to show them, how many people on the team they need in order to do that. So framing the revenue based on team capacity and abilities is the way to kick off that forecast. Everything else kind of falls in line after that.
Yeah, no, great. And I think a lot of this goes back to, and I know Adam wasn't in on that podcast, but obviously he knows this stuff great. It goes back to what we measure, right? So we're going to build a forecast, and then each month we're going to go back and measure it. So a lot of the stuff that Adam just talked about is very similar to what we talked about in our production podcast. And so once you come up with those production metrics, you want to make sure you're measuring after the fact how you're doing on these goals, because they're going to tell you, oh, we missed our forecast this month. It's going to tell you why. Was it hours? Was it rate? Was it customers? I mean, what was the thing that you're measuring as your production that caused you to miss your forecast that month?
Yeah, that's the key part, right? So once you've identified how you created your forecast, whether it's by hours and a billable time, or maybe a non-service based company where it's maybe units and or subscription based, where it's when what type of churns the product having, all these different factors that really go into identifying what makes that revenue tick is really important when you're creating it. But then measuring it, like what Jamie's saying, along the way is super, super important, because then that allows you to make changes along the way. Like Adam mentioned before, the forecast is very dynamic. It's not static. And so if you find that you thought your billable hour was $150 per hour, and in reality it came out to $175, well, then you're underestimating, your forecast, which in some ways, some people think, well, that's really conservative. In other ways, it's like, well, but then you're not preparing yourself for that crunch, because your people can't handle X amount of dollars. So you might be putting your people under a lot of stress to perform at that level. So you may be hiring people, so you need to be very realistic with it. But the key is constantly looking at those KPIs that you're generating and making those course corrections along the way. If you have the pie in the sky thinking your utilization is going to be 80% across the board, and that's what you base your forecast on, and find out 60%, well, don't keep it at 80% through the rest of the year. That's distorting your decision making. Bring it back down to reality is the key there. So constantly monitoring and managing those KPIs is really important part of the forecasting process.
Great. So Adam started with the top line. So if I've forecasted how much I'm going to make, what's my next step, Jody? I know how much revenue I'm bringing in. What do I need to determine next?
Next thing is you need to figure out how much expenses you have directly related to that revenue. So that's your production costs, and your production costs, as we talked about a little bit in a prior webinar or podcast, is when the basic direct expenses. So it's the team's salary, their burden costs, any direct costs related to production, whether that's software. That's all going to be related, to the production side. So identifying the people that's going to generate, that, and sliding that into your forecast on the expense side. So maybe you forecast you're going to be a $6 million company. Typically, production costs are going to be roughly 50% of that. So you should probably be budgeting somewhere in the $3 million of expenses, and breaking it down specifically to the people that are actually working on the projects. And so that's the second key part.
Yeah, I would say we put together a payroll grid. So people are going to be your most expensive. They're going to live everywhere in the P&L, but that's going to by far make up usually about 70 or 80% of your cost. So what we do is we put everybody on the team into whatever their role is. So we break them down between production, if they're working on billable work, even if they're in a non-billable capacity, if their main thing is delivery, then they belong in the production expense, as Jody had mentioned. And then other folks will live in admin and also marketing. So bucketing your team and making sure that their expenses are in the right places is probably the next part. All the benefits and additional costs like payroll taxes and everything else that go along with the team into the appropriate bucket. Again, that's going to probably take care of 70, 80% of your expense. Then all you have to do, the next step after that, is just put together a list of the other 10, 15 hard costs that you have. And again, bucket them in the right way. So if you have, put them in the admin category, if they're admin expenses, put them in, if you have a marketing budget or a biz dev budget, put those into their own little budget, facilities budget, if you have one, put that in there. Once you get those all listed out, what I typically recommend clients to do is go back and look at historics, see what you spent over the last year or two, and that's going to be your starting point. Round up or round down, look for anomalies, those kind of things. And then, leave yourself like an adjustment column. And then the next column is kind of what you want it to end at. So once you put in and filter in all those additional hard costs and you lay them in over top of what your employee cost is, it's pretty much built at that point.
Yeah, and try to be specific. If you know that you've got a conference coming up, let's say you're taking everybody to DrupalCon in May, you allocate that expense to May so that you know that, hey, that's going to hit in the month of May. Same thing with any kind of due subscriptions that is going to be like a reoccurring thing, just spread those out. But if you know they're going to hit in a specific period of time, allocate that time as real key. And then also to Adam's point, when we talk about admin costs, we're also talking about the employees that belong in the admin. So if you've got a bookkeeper, if you've got an accountant, a CFO, virtual CFO, or in-staff CFO, or if you've got anybody relating to the admin part of it, that they would go in the admin bucket, along with the sales and marketing team would go in the sales and marketing budget. Obviously, you're not going to have a person in the facility department, so that's going to be probably your only non-payroll department. But make sure that you don't just lump them all into one area. Why is that key, Jamie? Why would you not lump them all in one area?
Yeah, no, I think the main reason that I would want to do that is so I can compare across the industries. So I think you want to make sure you're comparable and you want to know exactly what you're doing as well. So one of the things we've talked about in previous podcasts is a lot of companies will try to go through and allocate those costs into jobs, right? So they'll go through and they'll say, oh, we have a desk and we're paying for Slack and we're doing this. So when I'm looking at job profitability, I want to assign those costs to that. But if you have those costs bucketed into other areas on the P&L, all I need to look at is my gross profit and look at the direct costs associated with that. Because I know, and we talked about this in our last podcast, I know my overhead costs are 35% of my bottom line. So if I'm able to do that math, I can say, as long as I'm hitting 50% on this job plus a little bit, then I know that I can still, those costs are okay for me. So as long as we're looking at them separate, it just makes for a much easier conversation than us trying to allocate that out.
Adam, what about sales on a non-service-based business, like some of our product people or even SEO, SEM people? How would you do the revenue side on those?
Yeah, we're not selling widgets.
Yeah.
So we don't applied overhead in a service-based model just doesn't make a ton of sense just because it can change with technology. It can change with ebb and flow with sales in a given month. And it just totally changes how you apply the overhead just because sales are low one month, that kind of a thing. So yeah, you definitely need to bifurcate the production expense from the rest of everything, I think. So
yeah, it definitely messes with your margins. Your margins will look a lot worse if you're marking up your product by 5% and your margin's only 30%. You're like, what's going on here? And then you have to look at that a little bit differently and look at the margins separately, separate them out for sure.
Yeah, well, I mean, so that depends based on, so a lot of times what will end up happening is we'll get an agency that's like, hey, I'm a $20 million agency. Well, no, your flow through ad spend is $15 million. You're a $5 million agency. So all their metrics and everything kind of get thrown off. So the first thing you got to do is just take a look to see if they're flow through or if they're markup. So if they're just flow through, they don't even belong on your P&L. Like they should be running through your balance sheet because it's just an in and an out of somebody else's money. It's a liability basically whenever you get that cash. So you don't even want that showing up on your P&L. And then whenever it's a percentage and you have the markup, then a lot of times there's a couple different ways to do it. If it's not as big of an example as that $20 million, you can put the whole thing on your P&L and kind of measure it out. But typically you just want to bring over the markup portion over to the net number over so that you can kind of see. Otherwise, it's going to just throw everything off if you're working with a $20 million top line number.
Yeah, so you might have a gross sales number and then a net sales number, and so that net sales number is just simply the gross sales minus all the expenses that Adam's talking about there, and then you're like you said, you're taking all your percentages then off the net sales, and that's the pretty much the key there for sure.
Great. Okay, so I've forecasted my revenue. I forecasted my expenses. Am I done now? Am I done with my forecasting process? I'm happy with the results there, Adam.
Yeah, I mean, if you're happy with the results, and again, that's now what we've done is we built the plan or the budget. We haven't really built the forecast. So, and as Jody mentioned, you definitely want to make sure that you put those ebbs and flows that you know of within each month, and you want to build your team capacity based on month as well. Because what will end up happening is you'll get through 2 months and you'll forget that, it's not like 2/12 of that expense just disappeared. Now, if it's like a bank service charge or something like that, then yeah, 2/12 is good. You can have those. But other expenses too, just to think about before we get off of the expense side of the build out, is we do things called bucket budgets, and they're extremely important to us. So marketing, for example, is a good one. So if you decide, hey, I've got $120,000 worth of, these 10 accounts make up $120,000, that's going to be my marketing budget. What you don't want to do, and you have no idea when you're going to spend that money, what you don't want to do in a forecast, so turning the plan into the forecast. So the plan might, that original budget, it just says $10,000 a month. When we operationalize this thing and we turn it into the forecast, one key change is going to be, just because January went away and we didn't spend any marketing doesn't mean we just burn off $10,000 of our marketing budget. Try to run that one by your marketing person. Hey, by the way, you've only got $110,000 to work with now. It's like, no, you still have 120. So that's some of the maintenance of turning and operationalizing your budget or plan into a forecast. So that'll be important maintenance along the way, I think. So you're never really done whenever it comes to the forecast side. You're always going to use it to kind of scale the business and modify for changes. That's kind of the dynamic part of the forecast.
Yep, exactly. I think the other part too is oftentimes when forecasting expenses, it takes a couple cuts at it, right? So if I have $6 million in revenue and then I go out and reach out to the teams and say, okay, marketing team, send me your original budget. And then you ask someone else to send you your original budget. You throw all those expenses into your plan and you might be coming up with a loss. You're going to say, oh, wow, we're going to have a loss next year. So then you kind of got to go back to your marketing team and be like, all right, give me what can you do without? Let's relook at this budget. So oftentimes when you go through expenses, it takes 2 or 3 attempts to get that expense forecast updated and budget ready to go before it actually is ready to go. Because I think that's the big thing is everybody wants a lot. And so you want to make sure you figure out what your priorities are. And the budgeting is a great time to have that discussion.
Yeah, I think it's important. What they're both alluding to is that when you're creating this, you make sure that you're not just creating internally with your CEO and the CFO getting together and creating this budget. It should be created with all the departments. Marketing should have a little say in what's going on. Production, as well as technology. All the different areas should actually have some sort of influence in this budget because they're going to have to live by the budget. So what you don't want to do is you don't want to say, well, hey, I would have done this had you budgeted more money. It's like, why didn't you mention you needed it in the first place? We could have done something back then, or we can change it now. So it's really important to have everybody, and especially as a CFO, should be really involved in all the different departments, helping create these budgets and keeping everybody a task on them.
So that's why we typically, at least I try to work with a lot of my clients in October. I think that's pretty standard for all of our clients here at Summit. Is October seems to be the time where you have enough clarification, where you're working with 3/4 of information, and you kind of have a flow and a rhythm of how things are going. So at that point, you can look into Q and use the entire Q4 to do exactly what you're saying. Just kind of hammer out the details.
Yeah, for sure. For sure. And I think the biggest thing that's been throughout this, and I think this is what I'm learning throughout the podcast, and I think I've always known this, but like our number one job is to be a conversation starter, right? Like everything we do is to start conversations throughout the team, right? So like, even the forecasting process, it's important to have a forecast. It's important to have goals written down, but the conversations that are started throughout the forecasting process are key to any business. And I think that's one of the most rewarding parts of being in finance is like you're involved in everything and you get to hear a lot of the conversations and kind of see what conversations make the business tick.
Yeah, I think that's one of the more sobering moments is whenever you look to see how the plan was built and what percentage they're going to be at, and then you go back to them and say, hey, like we actually built this thing for a loss. We've got to do some tweaking. Or you go to the biz dev team and you say, hey, based on the people we have on the team and everything, we should be an $8 million company. We're doing 5. So one answer is, how do we get to the 8? Or do we need to trim back? And if we trim back, again, if 70-80% of your cost is people, guess what that means? So now you got to kind of rescale and reorganize the team a little bit. And that comes up a lot whenever we do this planning, I think. We're here to help clarify direction. I mean, the owner and leadership is coming up with where they want to get, and they obviously are going to craft how they want to get there. But it's our job to kind of, map it all out and lead the way.
Great. So I think we've done a nice job helping people start a forecast here. And I think if people are listening to this, they at least have an idea how to start. So if anyone has any questions, I want to let everybody know we do have an email address for this podcast. If you want to email vcfo@summitcpa.net, you can ask any questions and one of the 3 of us will reach back to you. And also, if you want to be a guest or you have any recommendations for topics, please send an email to that address. Again, it's vcfo@summit, SUMMITCPA.net. So, that email is always there for you to reach out to us. Before we end the podcast, Jody, Adam, any final thoughts on the forecasting process that we didn't touch?
No, I think the key is just making sure that you understand the forecast is always dynamic. It's something that you want to change on a regular basis. Don't feel like you set it in stone and that you've got to, abide by it, all the way through. It's a dynamic situation. So it's something that you've got to be able to create in a dynamic mode and then manage it dynamically. So meaning that you've got to be able to know the KPIs that drive that forecast. And that's a really, really key thing there. And so then using those for strategic decisions is really important. And then, like I said, just looking not only at the profit and loss, but looking at your balance sheet or the cash position, your debt position, and so forth, and manage your forecast around it.
Great. Well, thank you, Adam. Thank you, Jody, for joining us. I think a lot came out of this podcast. And on our next episode, we hope to talk about recurring revenue. I know this is a topic near and dear to us because this is our model. And I think it's a model that is really helpful for any company that can build it. So that's our next topic, but look forward to talking to you guys again soon. Thanks for joining.
Enjoyed this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving virtual CPA success. We're here to be a resource in this ever-changing industry.